In Forex trading, price action tells us what's happening, but fundamental analysis explains why it's happening. It's the backbone of long-term trading success and a key tool for understanding the bigger picture behind currency movements. So, what exactly is fundamental analysis? In simple terms, it's the study of economic, political, and social factors that influence a country's currency value. Every currency reflects the health of its economy, and traders use fundamentals to gauge whether that currency should strengthen or weaken over time. Let's break it down step by step. First, economic indicators. These are official data releases that reflect the strength of an economy. Key ones include GDP, inflation, employment reports, retail sales, and interest rate decisions. For example, when a country's GDP grows faster than expected, it usually supports a stronger currency because it signals economic expansion and investor confidence. Next, central banks play a massive role. Institutions like the Federal Reserve, European Central Bank, and Bank of England control monetary policy, mainly through interest rates. When a central bank raises rates, it attracts foreign investors looking for higher returns, and that often pushes the currency higher. On the other hand, lower rates can weaken a currency as investors look elsewhere for yield. Now, let's talk about inflation data. Inflation measures how fast prices are rising in an economy. If inflation moves too high, central banks may hike rates to control it, but if it's too low, they might cut rates to encourage spending. Understanding this balance helps traders anticipate what central banks will do next, and that's where profits are made. Another vital part of fundamental analysis is employment reports. For instance, the U.S. non-farm payroll (NFP) report is one of the most watched events in Forex. A strong jobs number signals economic strength, and that often leads to a stronger U.S. dollar. Weak data, however, can cause a sharp sell-off. Don't forget geopolitical events and market sentiment. Political instability, elections, trade wars, or even global conflicts can cause major volatility in currencies. For example, a sudden escalation in global tensions can send investors rushing to safe haven currencies like the US dollar, the Japanese yen, or the Swiss franc. Understanding how sentiment shifts helps traders stay ahead of the crowd. Now, how do traders use all this information practically? They combine fundamental data with the economic calendar, tracking upcoming events like central bank meetings or data releases. By comparing expectations with actual results, traders can predict short-term volatility and long-term trends. For example, if the market expects a rate cut, but the central bank holds rates steady, that surprise often causes a sharp move in the currency. Here's the key takeaway. Fundamental analysis is about logic, not luck. It's about understanding the cause behind every market move. When you know why the market moves, you trade with confidence, not emotion. To summarize, economic indicators tell you the health of an economy. Central bank policies define the direction of currencies. Inflation, jobs, and growth data drive market expectations. And global sentiment shapes short-term volatility. In Forex, fundamentals build the foundation and technicals fine-tune the timing. Master both, and you'll start seeing the market with true clarity.